Hi, it's Charlie giving you Monday's update, and we've got a couple of things to go through here today. Firstly, from following on from last week's video, I knew that would happen. I just picked counter channels because they were on telecharts, and then a load of people were emailing in, having a look at them, and I was saying, well, yeah, have a look at them, let me know how you get on. But like I said, I do not use them. It was just purely just as an exercise for people to have a look at. So we've got something else to look at this week. But firstly, we did get an email. Well, we had several emails come in, but here's one come in from Dave. I've taken his email off. Sam, can you pass this on? So what he did, as you can see here, he said, okay, I've had a look at this. The standard description of the indicator uses it as an average range of 1 and says that a close above the channel is bullish and a close below the channel is bearish. This is on that counter channels. Using a 5-minute chart and taking a breakout of counter channel 1 and 2 as an entry with counter 1, 2, 3.5 and 4 levels as targets gave the results as shown on the chat spreadsheet. Test started off looking promising, but then it went downhill and never recovered. Please could use this example to warn against relying on a few early test results, which is great. I'm pleased about that because, like I said, don't get me wrong, like any indicator will have its uses, and it depends how you use it and in what context and all of that. So I'll bring up his spreadsheet so you can have a look at that. So you can see that over the test that he did, it had a win rate of 60% here, but winning amount 695 points, losing amount 1,000 points, giving a net gain of minus 300. And every different scenario that he looked at, which I think are over here, it actually didn't work out. So there you go, a good example there. But bear in mind, that was just in the way that he was using it, and there will be other ways that you can use it. Now, what else is there? One thing I must mention is Kim's doing a webinar this coming Thursday on backtesting. So if you're interested in testing something, then you might want to log into Kim's webinar or register for that webinar. Just go to our website; it's on there for this coming Thursday, because he's doing a webinar on backtesting itself, and we're going to be going through a lot of stuff on that. So because it is important if you're trying to learn something new or apply a new indicator or whatever, it is important to test it before you start actually going and using it. So that's quite useful. I've got something else from Carl as well. I mean, I was having a chat with Carl in the week, one of my old traders, and we had a chat. We have a chat about once every 6 months, and we had a chat last Monday, I think it was, just doing having an update. And he's doing quite well with his trading, and he's using a 2-to-1 risk to reward on his trades, and he's making money with his trading. But as always, we start having a chat through it, and then seeing if there's anything he could do better. And we had a good conversation, and I realised that actually on his trading, he could there was the potential to look at looking to take profits at 3-to-1. Reward to risk as opposed to 2-to-1, and as a result, he's done a load of testing, because again we're on the subject of testing at the moment, and it gave a better overall result, and so he's now trading with that outset. So sometimes you can be trading and you don't actually need to do anything with your setup. It's actually just, it could be something you need to do with your stop losses or something to do with your targets, without curve fitting it to back data. That's where you have to be careful. But he had so much slack within his system, within the setup that he was using, that it wasn't actually curve fitting to past data, and he ran all of the scenarios. He's got a piece of software that he uses, and ran all the scenarios, and the scenarios came back saying, yeah, you should be running at 3-to-1. So that was good to see as well. So maybe I'll go into more detail on that next week. Now, I've got someone else who's emailed in, I think he twittered it actually, asking me about tick charts. So what I'm going to do here, I've brought up a chart of the S&P futures contract. I'm actually recording this on Sunday, that's why the markets aren't moving here. I'm recording this Sunday afternoon, but I've put it on a 5-minute chart here, and what I'm going to do is, so we can see that over the last couple of hours the S&P had been down to 2070, and close up at 2076 within the last couple of hours. It closes at 10 o'clock or so. So and that's a time-based chart. You can have it on a 5-minute chart, 15-minute, whatever. But what about these tick charts? So I'm going to take this to a different interval now. So if I take this to a 1 tick chart, what does that actually mean? Well, if I take us to a 1 tick chart, what that means is it creates a new bar with every new trade that goes through. So as we can see, it all looks very weird because this is all, look at the timings here. Look, 10:14 and 50 seconds, 10:14 and 55 seconds over here. So we can see there's trades all going through, all at the same prices. So obviously a 1 tick chart is just not giving us, it's giving us too much information. So that's pretty much useless to us. So if I take us to a 233 tick chart, what it means is that a candle is only produced every 233 trades. Okay? So the difference between that and time, if you've got a 5-minute chart, obviously each candle changes every 5 minutes. 233 tick chart changes every 233 trades. So if the markets are moving really slowly, then it'll take a while for the new candle to develop. If, however, the markets are moving really fast, you're going to see lots of candles developing, which can be quite useful. So now again, I've got to be careful here because I'll have a load of people wanting to go off and trade using tick charts. I never use them. Kim never uses them. Again, it's just a different way. And so it's not like, oh, this is a better way of trading. It's just a different way of trading because it produces a candle when so many trades have gone through. Now let's have a look. You can see the time down here. So for example, this was down at 9 p.m. on Friday night. We can see that on this candle where I've got my cursor, that was at 8:59 and 38 seconds. And then if I move the cursor to the next candle, it's at 8:59 and 42 seconds. So as we can see, that it produced a new candle in 3 seconds. So, but then probably later on in the evening, let's have a look over here, for example, 9:14 and 37 seconds, 9:14 and 51. Oh, okay, a few more seconds there. So obviously a 233 tick chart is going to produce a huge amount of candles. So is that much use to us? Look, for example, look, between 8:50 and 8:55 p.m, look how many candles we've got. So if you're like a scalper or a very short-term trader, that may be of use to you, but you may want to come out further. So if I bring up my chart here and go out to something like a 1,000 tick chart, it'll be a little bit slower again, and so on and so forth. So again, now we can see that between 8:45 and 8:50, so in that 5 minutes, using a 1,000 tick chart, we've still got much more candles than like it would be if it was a 5-minute chart. But probably over here between 8:30 and 8:45, 9 o'clock and 10 o'clock, we've got a lot fewer candles. Can you see that? See how many candles we're getting here just in 15 minutes. But look how few candles we're getting in that whole hour there. So that's the difference. It just produces candles more often when when there's heavy volume, and it produces fewer candles, obviously, when there's fewer trades going through. Simple as that. Is there an advantage to it? At certain times, yes, there will be an advantage to it. When there is heavy volume coming through, because you're going to get that candle produced, and then you can have a look at the patterns. But is it a necessity? Well, I've said it already. Kim and I don't use them. I could go and look at and use them, but is it going to make any major difference to my trading? I don't think so. But it's just a case of, again, it's like indicators, what you like, what you don't like. So anyway, so I shall leave that with you. Some more food for thought this week. I'll probably cover off what Carl's and my conversation in a bit more detail, because he sent me his email of all his stats. But I think we're running out of time here. So yet again, sorry, no market commentary per se here today, but I thought this might be a bit more interesting than me just doing market commentary, and I know that Kim covers off some market commentary on his separate videos anyway. So I shall leave that with you. Back on Friday for live trading.